Welcome to this presentation on auto-enrolment update. My name is Alexandra Durrant. Auto-enrolment has been with us since October 2012. We started off with larger employers going into auto-enrolment schemes first, and smaller employers have followed. And from October 17, any business taking on staff for the first time must consider their automatic enrolment duties from day one. So what are the duties of an employer for automatic enrolment? Any employer with one or more workers, defined as an employee or a job holder, must look at auto-enrolment. Under the auto-enrolment regulations, the employer must provide a qualifying pension scheme for their workers. They must automatically enrol eligible job holders into the scheme. They must tell eligible job holders they've been enrolled and that they have the right to opt out. Both the employee and the employer have to pay contributions into the scheme, and these will be deducted through the payroll and paid over monthly. And finally, the employer has the obligation to register with the pensions regulator, providing details of the qualifying scheme and the number of employees that have been automatically enrolled. Failure to do that last step will give rise to a fine from the pensions regulator. I have heard of one employer that did everything that was necessary. So they assessed the staff, they auto-enrolled them, they paid the contributions over, but they failed to do the declaration with the pensions regulator, and so they were subject to a fine. So when we're looking at auto-enrolment, the employer needs to look at all of their employees, and we will be identifying job holders within those employees as they're the ones for whom auto-enrolment is applicable. You may be asking whether anyone can be excluded from auto-enrolment, and yes, they can. Individuals who are self-employed are not considered to be workers, so no obligation arises there. Office holders, unless they have a contract of service, such as non-exec directors, company secretaries and trustees, where they perhaps receive expenses or a fee for their work, then they can be excluded. And the more important one is one-person limited companies. So where I, Alexandra Durrant, set up Alexandra Durrant Limited, and I'm a director and therefore an employee of that company and perhaps have a contract of employment, if I'm the only employee, even though I have a contract of my own company, I am not eligible for auto-enrolment. However, at the point I take on another director who has a contract of employment, or I take on an employee who has a contract of employment, then I would need to automatically enrol. So they're the only excluded people, so that leaves the rest of our employees or the rest of our workers to be assessed. So this would include our 0 hours people, part-time employees, fixed-term contract employees, term-time employees, anyone that is working for us. The only people we could exclude would be someone working out their notice because they've resigned from their job, someone who is about to retire, or someone who is working out their notice under a dismissal. We have to include also employees who are perhaps not at work, so those who are on sick leave, short-term or long-term, and those on maternity, adoption and paternity leave. There are two main categories of workers, job holders and entitled workers, and we need to assess our employees to establish who is a job holder and who is an entitled worker. A job holder is anyone who has a contract of employment, who is aged between 16 and 74, who works or ordinarily works in the UK and has qualifying earnings. And those qualifying earnings for 2018-19 are set at £10,000 a year. This equates to £192 a week and £833 a month. So we need to assess our employees, see who fits the category of being a job holder, and from there we can decide whether they are going to be an eligible job holder, a non-eligible job holder, or an entitled worker. An employee will be an eligible job holder if they are aged 22 up to state pension age with earnings over £10,000. Anyone falling into this category is automatically enrolled into the pension scheme, and both the employer and the employee must make contributions. An employee that doesn't fit that category, but who is aged between 16 to 21 or between state pension age and 74 with earnings over £10,000, or aged between 16 and 74 with earnings of 6,032, the lower earnings limit for national insurance purposes, and £10,000, are known as non-eligible job holder. A non-eligible job holder is not automatically enrolled into the pension scheme, but they must be informed that they have a right to opt into the automatic enrolment scheme, and if they say yes, then both they and the employee must make contributions. This leaves us with the remaining employees who will be entitled workers, and this is an employee aged 16 to 74 with earnings of £6,032 or less. These workers have the right to join a pension scheme, but it doesn't have to be the auto-enrolment scheme, and they have a right to join. It's a choice, so the employer must notify the worker that they have a choice to join a pension scheme, and then if they say yes, they do want to join a pension scheme, the employee makes contributions but the employer does not. Having assessed the employees, the employer then has to identify a suitable pension scheme. For this, most employers will go to a financial advisor, or they can look on the internet at those offering auto-enrolment schemes, such as Nest, the National Employment Savings Trust, or the People's Pension, Smart Pension, or Now Pension. Some of these will have a fee for setting up and a monthly fee for carrying out the operations, but it's up to the employer to decide which is most suitable for their business and their employees. Once the employee is enrolled and all their personal information has been provided to the pension provider, they will receive notification from the pension provider of their rights and their opportunity to opt out. Having entered all your employees into the pension scheme, the employer then has to notify the pensions regulator with a declaration of compliance that they have successfully auto-enrolled their members of staff. And this declaration of compliance must be made within 5 months of the auto-enrolment date. Once an employee has been entered into the auto-enrolment scheme, at that point they will be notified they have the right to opt out. If they opt out within the first month of joining the scheme, their contributions and those of the employer will be refunded. The employer can't incentivise the employee to opt out. It must be the employee's choice. The employer will then apply to the pension scheme for an opt-out notice, which they will then complete and give to the employee. Of course, an employee staying in the scheme still has the option to opt out at a later date, but whether their contributions will be refunded or not will depend on the pension scheme. Once the employee has opted out of the pension, the employer cannot forget them. There is an obligation to re-enrol those employees 3 years after the anniversary of the auto-enrolment, and we'll talk about the re-enrolment later. The government have set the minimum level of contributions that have to be paid into an auto-enrolment scheme. These started off quite low and are gradually increasing, and have increased this year and will increase again in the new tax year from the 6th of April 19. And from the 6th of April 19, the minimum total contribution will be 8%, of which 3% will be paid by the employer and 5% for the employee. Currently, from the 6th of April 18, the total minimum contribution is 5%, of which 2% is from the employer and 3% from the employee. The employee will get 20% tax relief on their contributions. The contributions are based on qualifying earnings, and for 2018-19, the qualifying earnings, not the earnings trigger that we talked about for assessing the employees, qualifying earnings have been set at £6,032 and an upper earnings limit of £46,350. So an employee earning £25,000, for example, per annum, will pay no contributions from 0 to 6,032, and then will pay their contributions on the earnings that fall between 6,032 and 25,000. Someone who earns £50,000 a year will pay contributions on the earnings that fall between 6,032 and 46,350. In some cases, an employer may decide to pay more than their minimum requirement, so currently more than 2% and next year more than 3%. If the employer decides to do that, then the employee could reduce their contributions so long as the two contributions together equate to the minimum total figure. The employer has the ability to postpone auto-enrolment for an employee. The postponement can last for a period of up to 3 months. This is really useful when taking on a new employee. Perhaps the employee has a 3-month probationary period and the employer's not sure whether they're going to meet the criteria required for the job. So the employer would assess the employee on their start date, and if they were eligible for auto-enrolment, they would issue the employee with a postponement notice advising them that their auto-enrolment start date has been postponed for 3 months. At the end of that 3-month period, then the employer would reassess the employee, and if they've passed their probationary period, then obviously they would be entered into the scheme. Postponement is also useful for perhaps checking earnings spikes. So an employee may not reach the earnings trigger of £10,000 as a norm, but in a particular month or for a couple of months, their earnings may have increased due to overtime. So by postponing that employee, the employer has the opportunity to reassess at a later date, within 3 months of the postponement, to see whether or not their earnings really have hit the limit and whether or not they need to be enrolled. Having assessed employees and put them into the pension scheme, that is not the end of the employer's duties. Obviously, the employee must continue to assess new members of staff as they're taken on and continue to assess existing members of staff to see whether they are now eligible to join the scheme. There is also re-enrolment to be considered. Re-enrolment is necessary every 3 years. So every 3 years from your staging date, or every 3 years from when you first set up your auto-enrolment scheme. So if you had a staging date or first set up your auto-enrolment scheme 1st of September 2015, 3 years from there, 1st of September 18, you need to look at re-enrolment. The pensions regulator allow you to change that date and bring it 3 months earlier or 3 months later, but you must be within that 6-month window. At the re-enrolment date, you have to assess certain members of staff, and those employees would be anyone who asked to leave the scheme when they were first automatically enrolled, so they left at the beginning of the scheme, an employee who ceased to be an active member, so they've opted out but at a later date, and any employees who stayed in the scheme but opted to pay a lower contribution than the minimum necessary. So all of those individuals need to be re-enrolled. You do not re-enroll anyone who's already in the scheme, anyone who's 21 or under, and anyone who's at state payment age or over. Having re-enrolled those employees, after you've carried out the assessment, the employees will then join the pension scheme again, and they will be notified they have the right to opt out, which they may do. You then have another 3-year anniversary where you'll have to reassess them and maybe put them back into the scheme or not. Really important point on re-enrolment is that you also need to complete a re-declaration of compliance with the pensions regulator within 5 months of the anniversary of your staging date. If you fail to do this, then the pension regulator will issue penalties. Although you can use postponement when you first enrol someone into their pension scheme, when you're doing the re-enrolment reassessment of those people who've opted out, the opportunity to use postponement is no longer there. So hopefully you found this session useful, reminding you about auto-enrolment and the things that employers need to consider. Thank you for listening.